Our team here at GWCPA has been involved in over 100 business sale transactions. One of the biggest factors at the negotiation table is how to structure that deal for maximum tax efficiency. Now, if you clicked onto this video just to find out who pays the taxes in a sales transaction, the answer is that the seller pays the taxes. And if that's all you're looking for, then thank you for stopping by. But if you're willing to stick around until the end of this video, I'm going to talk about some situations where you as a buyer might realize some tax efficiency based on how that deal is structured and how that has a direct impact on the operations of your business in the year of purchase. Hi, my name is Barrett Young, and I'm a partner here at GWCPA, and we've helped over 100 businesses in their succession plans transfer from the founding generation to the second or third generation. And in this video, I'm going to go over some of the taxes involved in a sales transaction, both income taxes and capital gains taxes, first from a seller's perspective, and then again, how some of these might impact the buyer in that transaction as well. So first off, from the seller's perspective, taxes from the seller's perspective are going to be based off of two factors. The first is type, and the second is timing. So type has to do with whether the gain from the sale of that business is going to be classified as ordinary income or capital gains income. Capital gains income has a reduced rate, maxes out at 20% if you're in the highest tax bracket, whereas ordinary income can go as high as 37% in the year of that acquisition. And then also don't forget, you're going to have an additional, in most cases, 3.8% net investment income tax amount on incomes over $250,000 that you have to keep in mind in tax planning in the year of acquisition. Just to start off here, while we're talking about gain is determined by the sales price of that business, less any basis that you as the owner might have or as the seller might have in that business. And your basis in this case would be determined by the amount of initial investment that you put into that business, your accumulated earnings over the years of owning that business, minus any distributions that you took out from that business. And this is a shorthand way of getting to the basis or your actual investment into that business. And so if your sales price is greater than the basis you have in that business, you're going to have a capital gain. If your sales price is less than the basis that you've had invested into that business, if your business has gone down in value, then you would have a capital loss, most likely from the sale of that business. When we're talking about classifying that gain as ordinary income, this most often happens in an asset sale. And so referencing another video where I talked about the difference between an asset sale or a stock sale, an asset sale is going to be beneficial for the buyer of the business, not as beneficial for the seller. And the reason for that is if you have any fully depreciated assets within that business, you might have to have what's called depreciation recapture. So let's say that you sell a business and it's got a vehicle that's fully depreciated, $60,000 vehicle fully depreciated, and the total gain on that business is $80,000. Because that vehicle has been depreciated over the life of that vehicle, you're going to have to realize $60,000 of that $80,000 as ordinary gain, and then only the 20% there that was not taken as a deduction in the course of that business is going to be treated as a capital gain or get that lower value. And so this is why sellers typically do not want to see an asset sale. They would prefer a stock sale. And so to help you determine how much of that sales price is going to be taxed at ordinary rates in that sales agreement, in an asset sale, you're going to want to have that sales price allocated among the assets that are being acquired. Now, unfortunately, this is going to be beneficial for the buyer, and we'll get to that in a second. And so this actually pits the buyer's goals versus the seller's goals against each other at the negotiation table. And we're going to go over why it's beneficial for a buyer in a second. Now, stock sales or share sales are going to be most beneficial to the seller because the gain on the sale of those shares is going to be treated as capital gains. So think of it like owning shares in the public trading stock market. If you've invested $1,000 into some shares and you sell it for $1,200, you have a $200 capital gain on the sale of that stock. Now, again, this is beneficial for the seller because they get the capital gains rates. A buyer typically is not going to want to be involved in a stock sale unless there are other contingencies, because a stock sale also means I'm acquiring that business with all of its warranties, all of its liabilities that might be hanging out there. Whereas with an asset sale, a buyer is going to buy the assets of that company, not the shares in the LLC that was the holder of those assets. So the original LLC that you as the seller have will be liquidated, closed down, and the assets will transfer over. The second factor, before we get to the buyer's reasons, is going to be timing. And so if it is a cash transaction or if the buyer has secured funding from a bank or an investor and they're bringing the cash to that transaction, all of that income is going to be realized in the year of the sale, the year that it occurs, and it's going to jack up your income to the highest tax rate for that year, but then it's going to be over with. Now, if you spread out this transaction over a number of years, and this is going to be done through an installment sale, or when you as a seller might retain a note that is going to be paid back over a number of years by that buyer, you're actually going to spread out the realization of that income over those years as well. And so as you receive the payment in those future years, you're going to report a prorated portion of that gain in those future years as well. So let's say, for example, you sell the business for $400,000 and you receive $200,000 in the year of acquisition, and you're going to spread out the remaining of it, $50,000 per year over the next 4 years. You are going to recognize half of the gain from the sale of that company in the year of acquisition because you're receiving $200,000 or half of the sales price this year. And then in each of the 4 years after that, when you receive $50,000 each year, you're going to recognize 12.5% or 1/8 of the purchase price of that business. And so it won't increase your income as much in those years. So this is beneficial for keeping your tax low, but also keep in mind, you're also receiving smaller payments into the future. Now, in some situations, this is also riskier for you as the seller. There is a possibility that that buyer's not going to be able to pay that loan. They might default on it. If the operations tank or if they get cold feet, they walk away from the business. It does not happen often. I've handled probably 3 in my 20-year career, but when it does happen, it's a mess and it brings that seller back into the business where they thought they had walked away. And so that's something you want to keep in mind with an installment sale. Now let's talk about the tax implications finally for the buyer. I've already said throughout this video that the seller pays the taxes. That's directly. The seller will write the check to the IRS and to their state for those taxes. But what you might not be aware of is that you as a buyer are actually paying those taxes indirectly for the purchase of that business, because a good broker, a good seller, a good tax CPA is going to keep in mind that the seller is paying those taxes and it's already going to be written into the purchase price of that company. As always though, you'll also want to check with your own set of advisors, because your state might have instituted something like a brokerage fee or a transfer tax on the sale of the business. And so while the seller might be paying the income taxes, you want to be aware of if you as a buyer have to pay any of those kind of local transfer fees as well. But beyond that, the buyer also has a few situations that will directly impact their income statement this year that we want to be aware of in the negotiation, especially because of the fact that the purchase of that company, if it's being funded by the profit of the business, comes from after-tax dollars, which means if you are paying $50,000 to that seller over the next 4 years, that $50,000 is not a tax deduction. It's coming in after the taxes have already been paid on the profit. And so that money is going to the seller rather than available to you as a distribution as the owner. And so we do want to look for some tax efficiency in the acquisition. So the first one that I already mentioned is an asset sale. In an asset sale, you're going to want the purchase price allocated to the specific assets that you're purchasing. If you are buying a factory, if you are buying construction equipment or vehicles, if you're buying equipment heavy property, an equipment heavy business, then you're going to want that sales price allocated to those specific assets. If you are buying a factory, for example, or you're buying construction company, you're buying vehicles, those assets are 5-year assets. And so by allocating the purchase price of the business to those assets, you're going to be able to take 5 years of depreciation on the price allocated to those assets. If that purchase price is heavy on office equipment or furniture, non-machinery type items, you're going to have it allocated to 7-year items. And then from there, you might have, if you buy a building as part of the acquisition, that's going to be a 39-year asset currently. And so that depreciation is going to happen over the next 39 years. And so it really matters how you allocate that purchase price in an asset sale. Anything not allocated to a physical tangible asset, so let's say that the appraised value of all the assets in the business is $200,000 and you bought the business for $250,000, that other $50,000 is going to be allocated to goodwill, and that's going to be amortized over 15 years. And so you are going to recover that $50,000, but it's going to happen slowly over the next 15 years. The reason we allocate those assets is because on shorter life assets like the vehicles, the machinery, the office equipment, building improvements, things like that, we can probably accelerate depreciation on those items immediately in the year of acquisition. And so that's going to give you an immediate benefit to your income statement in the year of purchase. Another consideration you might take into account when you're negotiating with the seller is whether or not there's going to be an earnout on the sale of this business. So an earnout is when part of the sale of this company is conditioned on the owner continuing to work in that business. It could be as short as 3 months. It could be up to multiple years, but their sales price is going to be renegotiated contingent on them staying in the business, being able to transfer relationships and ensure that the business is stable and able to continue to grow without them just walking away after the transaction. So this is an earnout. This is compensation to that seller because they've effectively become an employee, but it is also a deductible expense to you as the buyer. And so that will immediately affect your income statement over the next couple years during that earnout. And then the last thing to keep in mind is interest. Interest on any notes used to acquire that business is tax deductible, whereas the principal is not. Just like with a home loan, the principal goes against the loan value, the interest is deductible in the current year. It is something to keep in mind because it affects your profit and loss statement this year, but keep in mind the more you pay in interest, you're paying money to a bank in order to not pay it in taxes. And so I would never recommend that somebody have a loan specifically for the reason of increasing tax deductions through interest. So while you're not actually paying income taxes on the purchase of this business, it is important to keep in mind that there are some things that impact your income taxes immediately as an owner of that LLC. If the concept of an LLC and self-employment taxes is completely new to you, then go ahead and watch this video next. I'm going to go over how to calculate and pay taxes as an LLC owner, and also how to pay yourself once you've paid those taxes from the profit of your business. If this video has been helpful for you, go ahead and give it a like, and I will see you on the next one.